Warren William here, Smartest Data Quick Definitions, absolute return strategies. Why incorporate an absolute return strategy via a fund or selection of stocks into your investments? Could some of the ideas or techniques implemented by absolute return strategies be incorporated into your investments? Let's go to the video, look into absolute return strategies, define, explain, and 3 bullet points at the end to take away. Absolute return strategies seek to have positive returns over a 2 to 3 year period. They could provide different return profiles, low volatility, and alleviate market drawdowns. Funds that follow an absolute return strategy have a different approach altogether. They are not seeking relative returns against a benchmark index. An absolute return strategy seeks to achieve positive returns over a defined period of time at a lower level of volatility. When an absolute return funds are included in a portfolio of traditional long-only investors, they offer several basic characteristics. Firstly, they diversify returns. Second, the correlations against traditional assets are generally lower. Third, drawdowns could be reduced. Fourth, volatility could be lowered. And fifth, returns per unit of risk could be improved. Absolute return funds seek positive returns over a time period which is longer than 12 months and could be up to 36 months or even greater. Typically, the time period will be defined as a rolling period. The longer the period, the more likely to achieve positive returns. The driving investment philosophy or concern of an absolute return strategy is what are the events or factors that could disrupt the financial markets. If identified correctly, they will seek to mitigate against potential losses. From the outset, the absolute return funds allocate across a variety of different assets classes, equities, fixed income, maybe commodities, gold, and real estate funds. Typically, absolute return funds will aim to have low correlations across the asset classes and also between the individual securities within an asset class. For example, the absolute return strategies could invest in equity sectors or stocks that have low correlations or different levels of volatility, or one could be high and the other one could be low beta. The performance of these funds are not measured against a benchmark index in fixed income or equities. Funds may benchmark against cash plus. These strategies differ from relative return strategies, which are specifically linked to the returns of an asset class. In closing, 3 quick bullet points regarding absolute return strategies. They seek to have positive returns over a defined period of time, greater than 12 months, probably around 36 months. Their influence in a portfolio of traditional investments could influence returns, correlations, drawdowns, and the level of volatility could be lowered. Absolute return strategies are not measured against a benchmark index.